Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, what's coming up on today's show?
Jim, we're going to talk about how the year is finishing for the resource juniors, what my plans are for 2025, and what bottom fish might make it onto next year's favorites collection.
So how is the year shaping up for the resource juniors?
This has been a pretty bad year in general for the resource juniors, but what is interesting is that for most of the year, the traded value of TSX Venture-listed resource juniors was higher than that of the non-resource listings. Now, that's different from that period, Trump's first term, 2017 to 2020. That's when the resource junior traded value was often less than 25% of total traded value. Crypto, cannabis, they dominated. Cannabis, of course, has now fallen by the wayside and has probably zero chance of making a comeback. But crypto is making a comeback. Now, what's interesting is in that in October, we had a pretty strong month for the resource juniors. Gold was making new highs, and although for the prior 4 or 5 months, the market had ignored gold's price rise, in October, it started to take it seriously. We started to see interest in the resource juniors, especially ones with a focus on gold. Now, since the election outcome, we've actually had the opposite effect. Now the non-resource listings on the TSX Venture exchange, their traded value exceeds that of the resource juniors, which is now fading back into that sort of low range from June until mid-September, when it was a pretty dismal period, no interest at all in these resource juniors. The problem that I see here is the market understands that many of these America First policies that are being considered, such as major tariffs against all of America's allies and also the non-allies, it will probably set the stage for a major economic downturn, not just in the United States, but globally. And that means metal demand will go down. So for the non-gold metals, there is this sinking feeling that things are going to go bad for the resource sector and, of course, the resource juniors. With regard to the hope that Trump might do reforms in the U.S. Forest Service and the BLM and make permitting exploration programs such a quicker, less painful and expensive task, that probably won't become reality until probably a couple years from now. This is not something you can change overnight. So in terms of help in the United States with the NIMBY problem that keeps juniors from getting permits in a timely manner and getting them renewed when they sort of drilled here and realized they should have drilled there and now they have to apply for new drill pad locations, that's probably not going to change under Trump. And in Canada, we have this horrific First Nations consultation problem. Trudeau has made elevating the First Nations to an aristocracy that has dominion over all of Canada into his signature achievement. And as a consequence of this, there are these endless consultation processes that are tied into the drill permitting process that's run by the provincial ministries. And the First Nations, supposedly they have some sort of deadline to consult, but they can drag this on forever. And so what we've got in Canada is a disruption of the process of exploration. And that's a problem for the juniors. Right now, Trudeau should be looking at these monster tariffs that the United States wants to slap against Canada and everybody else. It should be thinking in terms of we are a potential critical mineral supplier to all of the global West out there, Europe and countries in Asia that aren't part of the Chinese global East axis. Instead, he dithers with this First Nations reconciliation stuff and meddling in problems such as the Middle East, where really Canada has nothing useful to contribute. So the whole sector is kind of looking at this big sort of a slump coming up, and we're now seeing the value fading that's traded in the juniors. And it makes somebody like myself consider, well, I really should pack it in. Everything is stacked against the Canadian resource ecosystem. Probably dead by the end of this decade. No support in the financial establishment. No support at the regulatory level. No support at the federal and provincial level. And of course, in the rest of the world, the global South nations, we're seeing the companies being pushed out, marginalized, their projects expropriated, military coups in West Africa. There's really no place except Canada, Australia, and the United States where the juniors could still reasonably hope to do something. And yet in Canada and the United States, we have these blockades against exploration. Now, there is, however, an element of irrationality in me. And instead of just packing it in and saying, this is hopeless, I've decided I'm going to give it one more shot. And the reason I'm doing this is, in the past year, I have been engaged in my spare time in a volunteer capacity with a historical society that's in my town. And it's involved creating a database system to manage the digitization of all these physical archives going back a couple hundred years. They're all housed in one history center. And given all the anxiety about forest fires and that, which is not going to get better anytime soon, all this stuff could go up in smoke. So I've really had an entertaining time getting this all set up, moving all these images, documents online, accessible to everybody, and in the process, being able to recover all these stories that are buried inside these files that the public, except where somebody's written a book about it, really doesn't have access to. And it helped me realize that although I've been a bottom fisher for the past 4 decades, the system's not the same anymore. And it used to be you just looked for people, structure, and capital. And if you found those 3 things during the beginning part of a story cycle, you were bound to double, triple, maybe quintuple, or even tenfold your money. That doesn't really happen anymore. These 3 conditions are still critical, but they're no longer sufficient. There has to be a story that makes sense. It can't just be, we have this property, we have a drill target, we've got some money, we're going to drill a hole, we'll make a discovery, and the stock will go up. That story is lame. Nobody believes it anymore. It is dead. So what my challenge has been to look at the companies from the perspective of the story path to success. Now, KRO members, they want to hook to the story. They want to see that I've picked decent people. There's money there, and there's a reasonable structure. The insiders own enough stock that they're disinclined to want to roll it back and reset the company. And so my task is to dig out these stories. And because I've been doing this for many decades, and because a lot of company executives are not particularly articulate at expressing their story, there's a good kind of back and forth that I truly enjoy, talking to these executives, asking them, okay, what about this? And why didn't this happen before? And what is new? And what are you doing differently from what others have done that could cause you to make a discovery? Teasing these types of stories out of the companies and making them accessible to my readers. So going forward, I'm going to not just be a bottom fisher, but also a story hunter. And as part of this, I've decided, yes, we're now ready to renew for 2025. It's still $450 for the expiring December 31st, 2025, and you have until March 31st of next year to do this and be on board. After that, it switches to $200 a month and basically close the membership to a group of club of people who are interested in this whole bottom fish workshop concept that I've got going in my Slack forum, where we all collaborate and think about this and look for these things when they are cheap, and the focus will be on about 50 companies that I've got right now. I've got another 50 on the short list that requires more of a story deep dive to make sure the story does have some legs and what exactly it is. So I'll be adding those on in the next while. But in terms of the overall situation, it is very bleak for the juniors. There is capitulation happening now. I think even my bottom fish, whatever price I tagged them at in October and November, they're going to be cheaper by the end of the year. The market is giving up on the Canadian resource junior sector. In fact, with regard to the gold, even though gold's still here, $2,600 to $2,700, there seems to be, it's as if the market has become aware of Donald Trump's secret plan to sell all of the gold in Fort Knox and use the proceeds to load up with Bitcoin. It's as if the market senses this is like the final shoe to drop on our sector to kill the gold price and crank Bitcoin to the moon and leave these exploration juniors gasping for air and no audience left whatsoever.
Why do you think the outlook is so bleak for the Canadian resource juniors?
Well, part of what Kaiser Research platform is all about, it's I compile the data on all these Canadian and Australian listed resource companies, and with the search engine, I can see what everything, how much money everybody has left, what the share structure is, who the people are, what the chart pattern looks like. But I also create these statistical compilations. And right now there are 1,107 TSX Venture resource listings that are trading, not suspended or halted or anything like that. And 42% of this number have negative working capital totaling $2.1 billion. Another 15% have between $0 and $500,000 million working capital, really not enough to accomplish anything unless they have a strong farm-out deal to a major. Though some of these are interesting from a bottom fishing perspective because the story might simply need to be told properly to attract financial backers to get them the money to actually do something. But you do need money to get something done. And going forward, the seasonal cycle, it doesn't work anymore. Everything is now an individual, fundamental story path cycle. It's what the company is doing with its property and what it can deliver in terms of exploration results. That's the only thing right now that will make these stocks go up. Unless, of course, gold blows through $3,000 and the United States wakes up to its security of supply problem and rapidly changes the rules for the BLM and U.S. Forest Service and encourages juniors to go out there and start looking for deposits so that there can be a whole new wave of domestic metal supply coming out of Canada and out of the United States and ideally also out of Canada. Now, 43% of these TSX Venture listings, or 469 companies, they have more than $500,000. In fact, they have $3.5 billion total. And 53% of all these listings are trading below a dime. And you split those into two groups, those that have negative working capital and those that have positive working capital. So the ones with negative working capital, they owe $905 million to various creditors, sometimes management itself. And those with positive working capital trading below a dime, they're sitting on $553 million. So this is a very interesting situation. These stocks are depressed in terms of price. You can find the ones that have money. You can see which ones management still has enough shares to care about it and try to avoid a rollback at all costs. But it's the story path that I'm looking at. Now, the part that's really depressing is the whole financing environment for these resource juniors is completely deteriorated this year. In terms of the monthly financing activity that I track from that the TSX Venture publishes, I've got a bar chart which you can see in the comment published as part of this Kaiser Watch episode. 80% of the value raised in October, which was actually a very good month compared to earlier months, was in $2 million or more financing, basically a fraction of the listings. About 2/3 of the financings in number were less than $2 million. And what interesting trend is that the number of very small financings below $500,000, it's been rising all year, and that's not a very healthy sign because those financings aren't big enough to mount a drill program that could change the fundamental fortune of a company. These are staying alive financing, companies treading water, waiting for the market to accept that we are in a gold bull market or that we need to find a lot more copper, nickel, lithium, whatever metals that the world needs. So, and of course, 40% of the financings, just the number, not the value, were below 10 cents. So it's kind of a miserable financing environment. But what's very disturbing is what's happening in the flow-through sector. Flow-through financings can only be done by companies that have a Canadian project on which the money can be spent. And when an investor gives a company, say, $50,000, that money has to be spent largely, usually on third parties exploring a property in Canada. And that $50,000 flows through to the investor who in that following year, for example, if you do it this year for your 2024 tax calculations, and when you do that in April of 2025, you would be able to subtract this amount plus usually a percentage, as much as 30% from your income. Now, the cost base goes to zero, and the capital gains is calculated on whatever it is that you get from selling this stock. So the last half of the year is a favorite time to do flow-through because it's designated to be spent in 2025, but the flow-through write-off comes for that particular calendar year, and there's usually a 4-month hold anyways, and so you don't want to sell that stock in the year, flow-through stock in the year that you bought it, because then you instantly have a capital gains obligation that offsets your flow-through benefit. So to a large degree, it is a tax deferral system, punting it down the road over and over again. And the flow-through funds have made a big business out of this, rolling the proceeds from liquidating the stuff back into new flow-through, always punting it forward into the next year. And so this is why when you look at my chart that features just the flow-through financing activity in each month for the past 5 years, there's always a build-up of flow-through financing value activity in the sort of final 4 or 5 months of the year, and also stretching into January, February, and usually that is simply stuff that was done in December that's finally reported in the new year, but the TSX Venture stamps it as completed, say in January, but technically it was actually done before. This year is a very, very disturbing trend. September and October had abnormally low flow-through financing activity, and in mid-December, I'll get the stats from the TSX Venture, and we'll be able to see what November was like. But the word on the street is that these flow-through funds, they're looking for places to invest their money, but nobody wants flow-through money. And this is a very, very bad sign of the poor health of the Canadian resource junior ecosystem. Now, there's at least 3 reasons why this is happening. one reason is that the prices of these companies are so low that if they raise any meaningful amount of money in flow-through, the dilution goes through the roof. And that means come February, March, April, whenever it's free trading, all that paper is going to be raining into the market. Now, normally, this is as a result of this results in buying. Like we've got the new year, we've got the exploration season coming up. It has to be spent in the following year, and the company's all geared up. There's optimism. The story is articulated. People are buying it, hoping for that big discovery haul. But there's suddenly this foreboding sense that there's nobody in the wings, no audience left that's going to buy this paper, which means when it comes out, it's going to take these stocks really down badly. Now, another reason the companies with these depressed stock prices and poor treasuries don't want flow-through is none of it can be used to pay company salaries and all the other expenses of being a public company, which keep going up, even though the services that the regulators provide are counterproductive rather than productive. So they don't want to raise flow-through money unless they can also raise so-called hard dollars. So they'd rather just work on these little $100,000, $200,000 hard dollar financing with warrants attached than do flow-through money, which they have to spend while they themselves have to accrue their salaries and not get paid for doing anything. But there is a third, more subtle reason why there may be this slump in demand for flow-through financing by Canadian companies. And I alluded to it in the earlier question. It is that the permitting cycle in Canada, thanks to Trudeau's UNDRIP philosophy of elevating the First Nations to an aristocracy that has final say of everything that happens to their land, this has now become such an extended, convoluted, expensive process that companies are missing their seasonal expiration windows to even spend money. So with this enormous uncertainty about when you'll actually get the permit from the ministry, which waits for you to have all the consultations from First Nations, who can drag their heels and hem and haw and have no incentive really to do anything, because even if you give them a royalty or something, participate in down, they know it's going to take 10 years or so to get any mine approved and into production. So to them, that's not particularly interesting. So we've got this roadblock to actually getting exploration done in Canada, which the companies are starting to understand, and they're reluctant to commit to flow-through financing unless they've got already a permitted project ready to drill and everybody on side, yeah, go for it. So I think this flow-through trend, if it continues, is another sign that the Canadian resource junior ecosystem is dying.
Are any of your 2024 bottom fish collection eligible for promotion to your 2025 favorites collection?
You know, my favorites collection has turned into a huge pain in the ass. This year, the favorites are down 24%, pretty much the lowest for the entire year. And it's not because I picked shabby juniors. It's just a sign of how miserable the market has become for juniors engaged in resource exploration and development. Now, the concept of the favorites is that I put companies into the favorites collection that have been in the bottom fish collection and that have managed to get their act together, the missing pieces fall into place, and have delivered 100, 200%, maybe 300% gains to the bottom fishers who patiently accumulated them while they were in their bottom fish mode and held them. And when the story is suddenly coming all together and has running room, that's when I like to put them onto the favorites collection. But this year, my favorites are all like, a lot of them are going to be demoted to the bottom fish collection because of the poor performance that they have delivered, especially the ones involved in the lithium sector. But there's other stocks such as Endurance Gold, which was a favorite a few years ago, but ended up slumping and became a bottom part of the bottom fish collection. Last year was a disaster for them because of the forest fires that killed much of their exploration season. This year, they have made substantial progress, produced drill results which show how the Reliance project is coming together, and yet the stock just tracks sideways at 13, 14 cents, unchanged for pretty much the entire year, so not really eligible for promotion to the 2025 favorites collection. This obviously forces me to rethink this whole concept of what becomes eligible for the favorites collection, and I'll be thinking about this in December to figure out what companies I put into the favorites collection, even though they have behaved like bottom fish for the past year. Now, there is one significant exception from my 2024 bottom fish collection, and that is Sitka Gold Corp. And Sitka Gold Corp started the year off in that sort of 10 to 15 cent range. It was sort of the younger brother of the Snowline with its Valley discovery on the Rogue project in sort of the eastern part of Yukon. The RC project of Sitka Gold, it's to the west of the Keno Hill district and to the south of Victoria Gold's Eagle project, and it's seen exploration work for many decades. In the 90s, Noranda and Kennecott had the property. They drilled holes, usually generally shallow holes. It's known that there was this intrusion-related gold system-type mineralization all over the place. None of it was ever particularly high-grade enough or large enough to get anybody truly excited. Sitka Gold at the Blackjack deposit and the other one, the Eiger, They delivered a resource estimate a year or so ago, about 1.3 million ounces, just under 0.7 gram per ton gold. The majors are still interested in 1 gram per ton gold or better, so the stock was kind of like a classic bottom fish drilling. It's drilling more of the same stuff. But this year, things changed for the company. And one of it was a huge stroke of luck that took place on June 24th of this year. That's the day that they did a deal with Victoria Gold to acquire the Clear Creek group of claims that's to the south of the Blackjack holdings. Now, they needed this land because if they ever want to build infrastructure to develop the Blackjack and the other systems on their original property, they would need this land. But this also has the Rose Gold stock in it that had been drilled by Kennecott in the past. They knew there was this intrusions-related gold-style mineralization present. So in addition to expanding the property, consolidating all these bits and pieces that have been floating around through the decades, they also got access to parts of this system that have not really been drilled in the past. Now, June 24th was kind of the miracle of the year for resource juniors, because on the next day, the heap leach pad from the Eagle project collapsed. And the result was Victoria Gold very quickly was pushed into bankruptcy. And had that deal not been inked the day before, then this Clear Creek project would be stuck in the limbo of the bankruptcy trustees trying to figure out who's going to buy these assets and so on. So this was like, not just 11th hour, but in the last second of the day that these guys managed to pull off acquisition of this project. Now, they had the stock came alive in October when they reported assays for what they described as visible gold seen in deeper holes in the Blackjack. Now, the Blackjack open pittable resource goes down to 250, 300 meters, but they've now drilled holes that go deeper than that, and the grade has blossomed. So too deep for underground, for open pit mining, but starting to reach the threshold of underground mining, block caving, and this is where taking $2,600, $2,700 gold seriously in terms of real gold price, and perhaps going even higher as the America First policies completely change the order of the world, and make demand for gold much stronger than it has been. It's kind of still only modestly, the stock's only modestly responded to these fundamental changes at depth of this system and the higher real gold price and the location where they do have roads and access, and there's plenty of mining already in the area. It's not as remote. The First Nations in this particular area are used to mining in that. They're not particularly happy that this heap leach collapse happened at the Eagle project. But this is not uncharted territory in terms of working with mining companies to develop mines and create a local economy, and that's lots of road access. And this past week, they reported the first assays for the Rose Gold stock, which is in the southern part of that Clear Creek property that they acquired, and they had reported seeing visible gold. And again, this is like actual visible gold. This is not your take a hand lens and on 1 meter of core you look really close and you can see a tiny speck and you jump up and down and call it visible gold. No, this is, you can see this gold, a meter away, sometimes 2 meters away, and they delivered good assays. And the market largely shrugged. That was up over 50 cents earlier on the blackjack assays. It was down sort of like 39, 41 cents this week. And the market, they drilled 2 holes basically on one slice of this sort of east-west corridor, which Kennecott had drilled a series of shallow holes in the past. Maximum depth 75 meters, kind of so-so grades, maybe spiking up here or there. I suspect Kennecott back in those days was looking for another high-grade pogo type system. That's part of the whole intrusion-related gold system model. Didn't see anything there at the surface, so didn't expect to see anything better. Well, these holes now go beneath that previously drilled level, and they have good grade intervals. And this is within open pittable range. This is not like a blackjack where it's going to have to meet the underground mining criteria to end up being worth mining. This is within open pittable range. So Sitka Gold's got $15 million in the working capital. Yes, it has a lot of stock outstanding, but it has a strong audience. They'll be resuming work fairly early. This year they were, I think, drilling in February already. So it's not like they have to wait till June or July to resume drilling in the Yukon. So this company, they're going to be doing an updated resource estimate. Hopefully we see it blossom past 2 million ounces, but there's now so much exploration potential there. It's in an excellent location. And so Sitka Gold Corp is one of the few 2024 Bottom Fish Collection members who is very eligible to become part of my 2025 favorites collection.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.